It's Sunday, the 4th of March 2018. It's been about 3 weeks since the last video I put up, and the trends that I was talking about in that video are still sort of playing out in the market, I think, particularly around the US dollar and the S&P 500. But gold price been relatively weak the last couple of weeks, but importantly this week it held to the 1300 level, which I'd been talking about previously. It dipped below the previous low of this move around 1307 on Thursday, but on that, the trade news, the steel and aluminium tariff news out of America, that was quite positive for gold, and weak, weak for the dollar index, which I'll talk about in a second. But the fact that it's held that level with that nice reversal there, I think that's quite a positive move. And again, we've held this 1300 level, and I like this price action. I like this consolidation around above this 1300 level. It's a little bit potentially some weakness there, but I think with the general macro factors are moving in gold's favor. But I like how we've pushed up and held above this, past the midpoint of this move from 1230 to sort of 1360, and that's not something we've seen for the last year. Every time last year we get these peaks and we reverse strongly over a period of a couple of weeks. But we've consolidated here and we're range trading, and that's positive. So some of the speculative money can get out. And of course, we've talked about previously this sort of move around this heavy resistance level, the 4 or 5 year resistance level around these sort of high 1300s. This is the spot chart, the futures chart similar, but setting up nicely here for a bigger move. And as I said, I think the macro factors are really starting to set up well for gold, and just as people are kind of losing interest, which is ideal. The dollar index chart had a nice sort of look like it might be setting up for a double bottom sort of move here. But again, these are the same lines I'd drawn on here in the video a few weeks ago, and I've got this big red zone is the key resistance level now, and you can see that it's, even though it looked like it was breaking out above that sort of 90-40 level, which would be the double bottom sort of confirmation buy zone, buy trigger, I guess, it's failed there miserably on that Trump tariff news. And obviously I think when one of those tariff announcements comes out in the market, historically that's been a trigger for more and more retaliatory action, and I don't think we've sort of heard the last of this. And Trump's definitely seems to be positioning for a different sort of tact than he had for the last 6 months, and the trade stuff's really starting to heat up, and that I think that's going to be positive for gold. And this is, as I said previously, I was talking about this breaking out below the support zone and coming back to test it, and this is a textbook test of what's now resistance, and it's failed. And I think we're going to head lower again, as we have for the last year. Remember that I talked about this. This was my sort of analog in the mid 2000s period. As interest, this orange box was the last interest rate hiking cycle. So we're sort of the reason I'd sort of highlighted this is a lot of the macro factors are sort of similar now, and what we should be seeing at this stage of a cycle is a strong economy and a strong stock market. And the economy is not as strong. The stock market is starting to struggle, and that's just as interest rates have only really been raised to a 1.5% in the US, and they still think there's going to be a whole percent of rate hikes this year. But well, they're really going to be tested if the S&P 500 starts or continues the way it's behaving. Previously, I talked about this. We'd broken out above this trend that we've been in for the last 2 years, and I sort of talking about how we'd come back and potentially test the upper end of this range. That was similar to what we had in 2000 and the dot-coms, and that was a move up. Had a sudden breakdown. I think that was with some of the Nasdaq names. It broke down in April 2000, and then sort of weak rally back toward the top of the range, and it never reached that point again, well, for another 10 years. So I think we're seeing something very similar. Some of the price action has just been very weak. Uh, it's obviously it's come back to the test at the upper end of the range, form resistance. Even just on a daily sort of view of these candles, you got sort of a bearish engulfing candle here, and then three, I think what's sometimes called three black crows pattern, which is, I had to go back and look at some of the statistics on this pattern. As candlestick patterns go, this is the third most reliable candlestick pattern, this three black crows. So it's a bearish reversal pattern. This is textbook. I mean, this is only short-term trading sort of stuff, but that's a very high reliable indicator of lower prices in the short term, in that sort of week to 2 week time frame. So it looks like, suggests that every day that I've been watching the S&P 500, it's rallied sort of relatively well at the start of the day and then just getting pushed down toward the close. Friday was a bit better, but still it doesn't look strong, and it looks like it wants to head lower in the short term. And obviously there's a lot of people still sort of saying, oh, it's going to test the lows and this sort of stuff. But all of this, I think the other thing to look at is the volatility we're experiencing here. Like, if you look at all this move, 2016, 2017, basically every candle in the last month has had a higher range than any candles in the last 18 months before that. We're getting these 1.5%, 2% moves intraday, and there is almost nothing in here. So that's a sign of extreme volatility. We've had a lower high at the top, at high valuations, that breaking this upper trend. These are all basically textbook indicators of a topping process, and what you could call sort of distribution of and seeing that weaker moves into the close usually. This looks like, if you want to say, distribution from smart money into retail, and that's the trend here. I think we're forming that topping pattern, and there's going to be volatility, but I can't see a catalyst to move it higher, especially with some of the macro now questioning the bull market sort of thesis. When you start to see stuff about trade wars and stuff, that's not generally very good for the stock market. Some of the other things that I'm following, gold miner indexes, again, have been pretty weak, but importantly have held the resistance zone. This is the GDX, held that range about 21. Had that bit of a reversal with the gold price move on Thursday. Generally, it still looks a little bit weak, but as long as it can hold this level, I think it's well set up. Not a lot of people still following these gold miner names, but that's fine. I think they're very well poised here. We've had a nice consolidation for a year now, with gold set up well. I think these, and a lot of the mining companies have done very well in positioning themselves at a company level with better profitability and paying down debt, particularly in Australia, that is. So I think I still think these names are going to be doing well, and I've been acquiring the same ones I have for a few months. GDXJ, similar. It's held on to the sort of lower end of the range, a little bit more choppy as it tends to be, but I think as long as it can hold these levels, it looks well set. One thing I didn't talk about on the gold chart, what we're seeing here again reminds me of the sort of early 2016 period. We had this chop after the strong move in January in 2016. We had the chop for about 2 months in February and March. So where we are now, before we had that move higher, and that was when the gold stocks really took off in that sort of April-May period, and added another, I can't remember what it was, probably 50% in most names. So we're seeing that nice holding of the level here. In 2016, it was 1200 was the level being tested, and this year it's 13. So I think this is a nice little analog after that. Obviously, it hasn't been as big a move, but I think the psychology in the market is quite similar. One other thing, the gold price in Australian dollars, nice steady moves up here. Bit of volatility around this sort of 1700 level. That's kind of a key zone. We've been in here for 6 months, or maybe more, a year. So I think that's Australian dollars gradually weakening And I think it's weakening relative to gold in US dollar terms. So we're seeing a gradual move up in Australian dollar gold price, and I think that's going to continue. Some of the stuff around China is going to be interesting to watch and how that plays out on the Australian dollar. I know there's a chart that I've seen a few times, which is a credit impulse China, a credit impulse in China, and how that has sort of a lag, the lag of that relative to the Australian share market, and it tends to be about 6 months, I think. So that credit impulse peaked about 6 months ago, and I'm thinking that maybe that's catalyst for lower iron ore and coal and these sort of things that start to factor into the Australian dollar in particular. And trade, I mean, Australia, I read something this week, in periods of trade volatility, the Australian dollar is about almost always one of the weakest currencies. So again, that's not, a lot of this sort of trade stuff's not set up positively for the Australian dollar either. So that's where my bias comes in for Australian dollar gold. I have called previously 2000 as sort of my target by the end of this year. Whether we get there, I don't know. But again, the macro factors are lining up well for gold, and I think in particular Australian dollar gold prices. So all in all, I think quite positive price action this week, at least holding levels. And with the stock markets around the world, actually the other one I might have a look at is the XJO, the ASX 200. That's again pretty weak. It tried to rally up to those previous levels around that 6100, failed quite badly, and had that sort of similar move, those three black crows. And it's we're in it. This all looks like distribution to me around the 6,000 zone. I think this is heading lower. And I don't own any, even in my superannuation fund, I don't own any exposure to the ASX 200 because I just don't think it's worth being in. It's just a bad index in the terms of the weightings of the companies in it, and banks and supermarkets. And I've talked about this before. There's not a lot of growth here, and I just don't want to be in it at this point. I think it's a toppy sort of index, and with generally weak sectors as the leaders in the weightings. So I don't like to have a lot of exposure to the ASX 200. So that's where I'm thinking markets are developing this week, and I'll do another update in a week or two.